Imagine waking up one morning to headlines screaming that the banking system is teetering on the edge, and your savings could be at risk. That's the kind of alarm that Stanley Druckenmiller doesn't whisper. He shouts it with decades of market wisdom behind him. In his own candid style, he lays out not just the dangers lurking in 2026's financial landscape, but practical ways ordinary people can safeguard their money before it's too late. With markets moving faster than ever, ignoring these warnings could mean paying the price for complacency, and Druckenmiller's insight cuts straight to what really matters for protecting your wealth. Diversifying assets beyond traditional banks is not just a precaution, it's becoming an urgent necessity in today's increasingly unstable financial environment. When you rely solely on a single bank or even a handful of banks to hold your money, you are exposing yourself to systemic risks that are often invisible until they strike. Banks may appear solid on the surface, their balance sheets looking healthy, their logos familiar and trusted, but the reality is that financial institutions are highly interconnected, and a failure in one corner of the system can ripple outward with alarming speed. Stanley Druckenmiller, known for his unparalleled instincts in navigating complex markets, emphasizes that no one should underestimate the power of diversification. He has witnessed firsthand how overconfidence in a single financial entity can lead to devastating losses, even for seasoned investors. By spreading your money across different types of assets and financial vehicles, you're not simply hedging against one bank's failure, you're creating a buffer against the unpredictable shocks that can cascade through the entire banking sector. Diversification goes far beyond opening accounts at multiple banks or keeping money in savings and checking accounts. It's about strategically placing your wealth in instruments and assets that respond differently to economic conditions. For example, government-backed securities, while offering lower returns, carry minimal default risk and can act as a stable anchor when volatility hits. In contrast, equities, bonds, and commodities offer higher growth potential but fluctuate according to market dynamics, interest rates, and geopolitical tensions. The goal is not to chase maximum returns blindly, but to construct a portfolio where the weaknesses of one asset class are offset by the strengths of another. This approach transforms your wealth from a single, threaded safety net into a robust, multi-layered system that can withstand shocks. Druckenmiller often reminds investors that diversification is not just a technical strategy, it's a mindset. It requires humility, a recognition that no one can perfectly predict the next market move, and that preparation is your strongest ally. One of the most compelling reasons to diversify beyond traditional banks is the evolving nature of banking risks themselves. Banks are no longer just local institutions, they are global players engaged in complex financial engineering. Their exposure to derivatives, interbank lending, and other high-risk financial instruments can magnify problems in ways that are almost impossible for an individual depositor to track. A bank that seems stable in one quarter may, behind the scenes, be leveraging assets in ways that make it extremely vulnerable to sudden interest rate changes or economic shocks. By distributing your wealth across a combination of banks, credit unions, and non-bank financial institutions, you reduce the likelihood that a single point of failure will jeopardize your overall financial stability. Druckenmiller's advice underscores the importance of not being seduced by brand recognition or past performance alone, because history has repeatedly shown that even the most prestigious banks can falter unexpectedly. Diversifying also opens the door to alternative asset classes that can act as a hedge when traditional banking systems are under stress. Real estate, for instance, is tangible, historically appreciating over time, and less susceptible to the day-to-day fluctuations that affect banks and stock markets. Precious metals like gold and silver carry intrinsic value and have a proven track record of retaining worth during crises. Some investors explore private equity, collectibles, or even certain cryptocurrencies, not as speculative gambles, but as ways to ensure that part of their portfolio remains insulated from banking system shocks. The key is balance. allocating enough to these alternatives to create meaningful protection without overexposing yourself to volatility that could backfire. Druckenmiller's experience shows that those who fail to think creatively about asset allocation often find themselves scrambling when conventional systems start to strain. Another crucial dimension of diversification is geographic distribution. Holding money in institutions across different countries or regions can provide additional layers of protection against localized banking crises. Financial systems are interdependent, but they do not collapse simultaneously everywhere. By spreading assets across multiple jurisdictions, you reduce the risk that regulatory failures, economic downturns, or political upheavals in one nation will wipe out your savings. This strategy requires careful attention to legal frameworks, deposit insurance limits, and currency risks. But for those willing to manage these complexities, the payoff can be significant. Druckenmiller has repeatedly pointed out that global thinking is not optional in today's interconnected world. It's essential for anyone serious about preserving wealth. Finally, diversifying beyond traditional banks forces a mindset of vigilance and engagement. It compels you to understand your assets, monitor risks, and stay proactive rather than reactive. When your wealth is concentrated in one place, it's easy to become complacent, lulled by convenience and familiarity. Diversification disrupts that complacency, making you an active participant in the health of your financial future. You start analyzing trends, evaluating institutions, and considering scenarios that might otherwise be ignored. Druckenmiller's warnings about the fragility of financial systems are not just theoretical, they are calls to action. Those who embrace the principle of diversification are not simply spreading money around, they are building resilience, gaining peace of mind, and positioning themselves to navigate whatever turbulence the markets may throw their way. Keeping a portion of cash in liquid, safe instruments is one of the most fundamental yet often underestimated strategies for navigating turbulent financial waters. While diversification provides a broad safety net, liquidity ensures immediate access to funds when crises strike, market volatility spikes, or banks impose restrictions on withdrawals. Stanley Druckenmiller emphasizes that having readily available cash is not a sign of fear or indecision, it's a strategic maneuver rooted in foresight. When financial systems wobble, the difference between those who can act quickly and those who cannot often comes down to the simple fact of having liquid assets at hand. Unlike investments that may require days or weeks to convert into usable funds, cash and cash equivalents allow for instant action, whether that means seizing opportunity or weathering a storm. The thrill of market instability becomes manageable when part of your portfolio is untethered from the delays and uncertainties of complex financial instruments. Liquid assets come in several forms, each offering varying degrees of safety, accessibility, and return. Traditional savings accounts, money market accounts, and short-term government bonds are common vehicles for liquidity because they balance immediate availability with security. The appeal of these instruments lies in their predictability. They are not subject to the wild swings that often characterize equities or commodities. By holding a portion of wealth in such instruments, investors are effectively creating a financial shock absorber. Druckenmiller often points out that this is particularly crucial during periods of systemic stress when banks may temporarily freeze certain transactions, impose limits on withdrawals, or see their value fluctuate in ways that threaten confidence. In such moments, those with liquid cash can act decisively, whether that means covering unexpected expenses, taking advantage of sudden market dislocations, or simply maintaining peace of mind. Maintaining liquidity also provides a psychological edge. In times of uncertainty, fear and indecision can cloud judgment, leading to rash decisions that amplify losses. Having cash on hand offers flexibility and control, allowing for measured, strategic moves rather than panicked reactions. This is precisely why Druckenmiller warns against overcommitting to assets that, while potentially lucrative, cannot be quickly accessed or sold without incurring significant costs. Real estate, private equity, and certain bonds may deliver strong long-term returns, but when liquidity is low, their value can become irrelevant in the face of immediate financial needs. The comfort of knowing that you can tap into a safe reserve of cash at a moment's notice is not just about convenience. It's about survival in an environment where timing can make all the difference. Another dimension to consider is the role of liquidity in seizing opportunity. Financial crises, bank failures, or sudden market corrections often present unique chances to buy undervalued assets at steep discounts. Investors who have committed their funds entirely to illiquid or high-risk investments may find themselves unable to capitalize on these opportunities, watching potential gains pass by because they lack accessible funds. Druckenmiller has demonstrated repeatedly that the ability to deploy capital quickly during market dislocations is a cornerstone of exceptional investment performance. Cash in liquid instruments is not a passive safety measure. It is a strategic tool that enables participation in situations others cannot touch, turning volatility into potential advantage. The question of how much liquidity to maintain is crucial. Too little, and you risk being trapped when sudden needs arise. Too much, and your wealth may underperform in the long run due to missed growth opportunities. Experts like Druckenmiller suggest a calculated approach, keeping enough liquid assets to cover several months of essential expenses or an equivalent portion of your portfolio that ensures flexibility while still allowing other investments to grow. This approach requires ongoing monitoring and adjustment as financial conditions, personal circumstances, and market risks evolve. The precise balance is individual, but the principle remains universal. Liquidity is the foundation of resilience in uncertain times. Maintaining liquidity also interacts with broader diversification strategies. Cash and cash equivalents serve as the counterbalance to riskier or less accessible investments, creating a dynamic portfolio that is both secure and responsive. When banks falter, markets tumble, or geopolitical events trigger sudden shifts, the presence of liquid assets can prevent forced selling at inopportune moments, preserving the overall value of your portfolio. Druckenmiller's guidance stresses that this is not theoretical. Historical banking crises and market crises consistently show that investors who maintain liquidity avoid the cascading losses experienced by those who have tied up all their resources in illiquid or high-risk instruments. The peace of mind that comes from knowing a portion of your wealth is always accessible cannot be overstated. It empowers rational decision-making and provides a buffer against panic-induced mistakes. Finally, liquidity must be managed intelligently to maximize its protective power. Simply holding cash under a mattress or in an account with minimal interest may provide safety, but it also leaves wealth exposed to inflation and opportunity costs. Choosing liquid instruments that balance accessibility, security, and modest returns enhances the effectiveness of this strategy. Druckenmiller's insights suggest that disciplined allocation, regular review, and an understanding of market conditions are key to ensuring that liquid assets serve their intended purpose: immediate availability, protection against financial shocks, and the flexibility to act decisively in an unpredictable world. Considering gold and other hard assets as a hedge adds a dimension to wealth protection that cash and traditional banking simply cannot provide. While liquidity offers immediate access and diversification spreads risk across financial instruments, hard assets have intrinsic market sentiment, interest rate fluctuations, and banking crises. Stanley Druckenmiller frequently underscores that when the system shows signs of fragility, the tangible nature of gold, silver, and other real assets becomes not just a safe haven, but a strategic weapon against the erosion of purchasing power. Unlike paper currency or digital entries in a bank ledger, these assets exist independently of any institution, making them resilient against failures that can cascade through interconnected financial networks. Their historical performance during periods of economic uncertainty reinforces their role as a cornerstone of any comprehensive wealth protection plan, particularly when warning signs of a banking crisis begin to appear. Gold has long been recognized for its ability to retain value in times of financial turbulence. Its scarcity, universal acceptance, and resistance to inflation make it a unique asset capable of providing stability when traditional investments falter. Druckenmiller often points out that gold is not merely a commodity, but a form of financial insurance that responds differently from stocks, bonds, and cash. When interest rates rise or bank solvency becomes questionable, paper-based assets may lose value, but gold often appreciates, reflecting investor demand for safety. Similarly, other precious metals like silver, platinum, and palladium offer diversification within the hard asset category, each with their own market dynamics and industrial applications. By holding a portion of wealth in these instruments, investors can protect against systemic shocks that might erode confidence in traditional banking institutions, ensuring that some portion of their portfolio remains insulated and potent. Beyond precious metals, tangible assets such as real estate, farmland, and collectibles can provide additional layers of protection. Real estate offers not only intrinsic value but also the potential for income generation through rentals or leases. Farmland, increasingly viewed as a finite and appreciating resource, can serve as both a productive asset and a hedge against currency devaluation. Even collectibles, ranging from rare art to classic cars, carry value independent of conventional markets, although they require careful knowledge and strategy to ensure liquidity when needed. Druckenmiller emphasizes that these assets act as a counterweight to highly leveraged or volatile financial instruments, giving investors a way to preserve wealth even as paper assets fluctuate wildly. They offer a sense of control and permanence, which is invaluable when markets are unpredictable and conventional banking solutions are under stress. Hedging with hard assets also interacts with the psychology of financial security. When investors witness banks failing, market values swinging violently, or digital wealth becoming temporarily inaccessible, the knowledge that they hold something tangible offers reassurance. This psychological edge can prevent rash, panic-driven decisions that often amplify losses during crises. Druckenmiller often highlights that a well-prepared investor treats hard assets not as speculative bets, but as instruments of stability, using them to maintain composure, preserve options, and act strategically in response to unfolding events. The thrill of volatility becomes manageable when part of your wealth has inherent value, immune to the whims of failing institutions or sudden policy shifts. Timing and allocation are critical when incorporating gold and hard assets into a protective strategy. Too little exposure may leave an investor vulnerable to rapid devaluation of paper assets, while overcommitting can limit growth potential in other areas of the portfolio. Historical evidence and Druckenmiller's experience suggest that a balanced approach, holding a meaningful but not overwhelming proportion of total assets in hard forms, creates resilience without sacrificing the opportunity for wealth accumulation. This allocation must be periodically reviewed and adjusted in response to market trends, inflation expectations, and geopolitical developments, ensuring that hard assets continue to fulfill their role as an effective hedge against uncertainty. Global diversification also benefits of hard assets. By holding gold or other commodities in multiple jurisdictions or storage methods, investors reduce the risk that political or regulatory changes in a single country could interfere with access. Similarly, investing in international real estate or land adds another layer of protection, as crises are rarely perfectly synchronized across all regions. Druckenmiller emphasizes that considering geographic distribution alongside the choice of asset type amplifies the hedge, creating multiple fail-safes that work in concert to protect wealth. Finally, incorporating hard assets encourages strategic thinking and active management. Unlike cash, which may sit passively, or bank deposits that rely on institutional stability, gold, real estate, and other tangible assets require monitoring, understanding of market conditions, and sometimes physical oversight. This engagement sharpens an investor's awareness of risk, fosters proactive decision-making, and ensures that protective measures are not passive but dynamic. Druckenmiller's guidance consistently stresses that wealth preservation in uncertain times is not about inaction. It's about thoughtful allocation, vigilance, and the willingness to act decisively when circumstances demand it. By including gold and other hard assets in a diversified portfolio, investors create a multi-layered shield capable of withstanding shocks, seizing opportunities, and preserving both financial security and strategic flexibility. Reducing exposure to highly leveraged financial institutions is a strategy that becomes critical when warning signs of systemic instability appear. As Stanley Druckenmiller has repeatedly emphasized, leverage amplifies both gains and losses, and while it can produce impressive short-term returns, it also transforms financial institutions into fragile entities that can collapse under pressure. When a bank or investment firm carries far more debt than its assets can safely cover, even small shocks in the market can trigger cascading failures, eroding not only investor confidence but also the stability of broader economic systems. For ordinary depositors and investors, exposure to such institutions can be perilous because the fallout of their miscalculations often reaches far beyond the boardroom, threatening personal savings, retirement accounts, and the value of everyday transactions. Druckenmiller's insight underscores the idea that avoiding overleveraged institutions is not about avoiding risk entirely. It is about controlling risk and protecting oneself from vulnerabilities that are entirely avoidable. Highly leveraged institutions operate on a delicate balance between borrowed capital and actual assets, often engaging in complex financial instruments like derivatives, credit default swaps, and other forms of off-balance sheet exposure. While these tools can magnify profits in theory, they also magnify losses exponentially when market conditions sour. History offers numerous examples where institutions suddenly collapsed because their leverage made them unable to absorb unexpected shocks. Druckenmiller points out that during such moments, the most sophisticated investors can struggle, let alone average depositors. Exposure to these entities is akin to walking a tightrope during a storm. A single misstep can trigger losses that ripple far beyond the initial point of failure. Reducing exposure, therefore, is a proactive measure that prioritizes long-term security over short-term allure, allowing investors to maintain control and agility when conditions deteriorate rapidly. Evaluating leverage requires full analysis of financial statements, debt to equity ratios, and risk management practices. High leverage often correlates with aggressive strategies, high-risk lending, and an over-reliance on external funding, all of which magnify vulnerability during market corrections. Druckenmiller stresses that investors should scrutinize not just the headline financial figures, but also the underlying assumptions about interest rates, asset liquidity, and market stability. Even institutions with strong reputations can harbor hidden risks if their leverage is excessive or poorly managed. By consciously reducing exposure to such entities, investors avoid situations where systemic shocks can wipe out substantial portions of their wealth before they have the opportunity to react. Diversification across institutions with varying degrees of leverage is an effective method for mitigating this risk. Instead of concentrating funds in a single highly leveraged bank or investment firm, spreading assets across lower leverage institutions reduces the probability that a single collapse will have catastrophic consequences. Druckenmiller often highlights that prudent investors seek to balance safety and growth, combining stable, well-capitalized institutions with selective exposure to higher-risk entities where potential returns are justified by robust risk controls. This approach preserves opportunity without compromising the foundational security of one's portfolio, creating a structure that can absorb shocks without triggering panic or forced liquidation. Understanding the systemic implications of leverage is equally important. Highly leveraged institutions are interconnected through lending, derivative positions, and other financial contracts, creating a network where the failure of one node can cascade across the system. During periods of stress, institutions with high leverage can act as amplifiers of instability, spreading losses far beyond their immediate circle of operations. By minimizing exposure to these entities, investors not only protect themselves but also reduce participation in the mechanisms that exacerbate financial crises. Druckenmiller's guidance emphasizes that awareness of systemic risk is not optional. It is essential for anyone seeking to preserve wealth in an environment where small imbalances can lead to large-scale disruptions. Reducing exposure also requires monitoring changes in leverage over time. Financial institutions may adjust their capital structures, take on additional debt, or engage in riskier activities as market conditions evolve. Investors must remain vigilant, regularly reassessing their exposure and relocating assets as necessary to maintain a safe balance. Druckenmiller warns that complacency can be dangerous. What may appear as a well-capitalized and secure institution today can become highly leveraged tomorrow if oversight lapses or aggressive growth strategies are pursued. Continuous evaluation ensures that portfolios remain resilient and that exposure to potential crises is minimized before it becomes critical. Finally, avoiding over-leveraged institutions encourages strategic flexibility and peace of mind. When markets are volatile and banking systems show signs of strain, knowing that your wealth is not tied to these that could collapse under pressure provides freedom to act decisively. It allows for reallocation of assets, capitalizing on opportunities presented by market dislocations, and avoiding forced losses due to institutional failures. Druckenmiller's experience demonstrates that risk control, not speculation, is often the differentiator between those who weather crises successfully and those who suffer devastating setbacks. By consciously reducing exposure to highly leveraged financial institutions, investors align their portfolios with the principle of resilience, ensuring that they retain both protection and the capacity to respond when the unexpected strikes. Monitoring interest rate and inflation trends closely is a strategy that separates reactive investors from those who are consistently ahead of the curve, and Stanley Druckenmiller has long emphasized its critical importance for safeguarding wealth in volatile times. Interest rates and inflation are not abstract economic concepts. They are powerful forces that directly influence the value of cash, bonds, equities, and even real assets. When interest rates rise rapidly, the cost of borrowing increases, asset prices can decline, and highly leveraged institutions feel pressure almost instantly. Inflation, on the other hand, erodes purchasing power, making cash and fixed income investments less valuable over time. Druckenmiller's approach combines vigilance with interpretation, treating macroeconomic signals as early warnings that allow investors to adjust allocations before losses accumulate. By monitoring these trends, you can anticipate the ripple effects on banks, markets, and individual investments, and position your portfolio to both protect and potentially profit from changing conditions. Interest rates act as the lifeblood of the financial system, influencing everything from mortgage payments to corporate borrowing and even consumer spending. When central banks raise rates, the intention is often to cool inflation or prevent economic overheating, but the consequences can be wide-ranging. High interest rates increase debt servicing costs, reduce liquidity, and can trigger stress in banks or businesses that rely heavily on borrowed capital. Investors with large positions in interest rate-sensitive assets, such as long-term bonds or leveraged financial institutions, can face sudden and severe losses if they fail to anticipate these shifts. Druckenmiller's perspective emphasizes that understanding rate trends is not about predicting exact numerical changes. It is about recognizing directional shifts, assessing their potential impact, and making preemptive moves that reduce vulnerability and maintain strategic flexibility. Inflation adds another layer of urgency. Even moderate inflation steadily erodes the real value of cash and fixed income holdings, silently reducing purchasing power over months and years. During periods of accelerating inflation, traditional bank deposits or low-yield bonds may deliver negative real returns, leaving investors exposed even if the nominal value appears stable. Druckenmiller warns that ignoring inflation is akin to ignoring a slow leak in a boat. It may seem harmless at first, but over time it can lead to critical instability. Monitoring inflation indicators such as consumer price indices, producer price trends, and commodity prices allows investors to adjust their portfolios proactively, shifting toward assets that retain value or appreciate response to rising prices, including hard assets, inflation-protected securities, or equities in companies with strong pricing power. The interplay between interest rates and inflation is especially important. Rising inflation often prompts central to increase rates, creating a dual impact on markets' higher borrowing costs and reduced asset valuations. Investors who fail to monitor these movements risk being caught off guard by rapid corrections in stocks, bonds, and other investments. Druckenmiller's track record illustrates that those who actively follow and interpret these macro trends can strategically reposition their holdings, locking in protection and identifying opportunities that others may overlook in the chaos of a shifting economic landscape. This proactive approach turns what might appear as market turbulence into actionable intelligence. Interest rate and inflation trends also inform decisions about portfolio composition. For example, during periods of rising rates, short-term bonds and floating-rate instruments often outperform long-term fixed-rate securities, while certain sectors of the equity market, such as financials or commodities, may benefit from inflationary pressures. Conversely, high leverage or overexposure to interest-sensitive assets can magnify losses. Monitoring these trends allows investors to reduce risk in vulnerable areas while increasing exposure in sectors poised to gain, balancing safety with potential growth. Druckenmiller emphasizes that this requires constant attention, as economic conditions can shift rapidly, and what seems advantageous today may become risky tomorrow. Global considerations further complicate the picture. Interest rates and inflation are not isolated phenomena. They are influenced by international capital flows, trade dynamics, currency fluctuations, and geopolitical developments. Investors with exposure to multiple markets must track trends across countries, evaluating how local monetary policies and inflationary pressures interact with their global holdings. Druckenmiller's insight highlights that understanding these broader interconnections allows for timely adjustments, reducing vulnerability to shocks originating in one region that could cascade across global financial networks. This global perspective adds depth and foil to a strategy that might otherwise focus too narrowly on domestic economic indicators. Finally, actively monitoring interest rate and inflation trends encourages disciplined, informed decision-making rather than reactive or emotionally driven moves. It transforms uncertainty into opportunity by providing context for market behavior and a framework for action. Investors who follow Druckenmiller's guidance learn to anticipate not just individual market swings but systemic shifts, allowing them to adjust cash positions, rebalance portfolios, and deploy capital with confidence. The thrill of market volatility becomes manageable, and the risk of financial surprises is reduced when one treats macroeconomic indicators not as abstract data, but as actionable signals guiding every investment decision. Staying informed and ready to act quickly on market shifts is the final, yet perhaps most crucial, component of protecting your money in times of financial uncertainty. Stanley Druckenmiller has repeatedly highlighted that knowledge alone is not sufficient. It must be coupled with speed, decisiveness, and the ability to translate insight into action. Markets move faster than ever, with digital trading, global interconnectivity, and real-time information creating a landscape where conditions can change in minutes. Investors who fail to stay alert risk being blindsided by sudden shifts in liquidity, regulatory changes, or economic shocks that can erode wealth almost instantly. Being informed is not a passive exercise, it is an active, continuous process that requires attention to both macroeconomic signals and the subtle undercurrents of financial markets. The foundation of staying informed lies in developing a disciplined approach to gathering and interpreting data. This includes monitoring economic reports, central bank communications, interest rate announcements, and inflation indicators, but also extends to tracking geopolitical events, corporate earnings, and market sentiment. Druckenmiller emphasizes that the difference between a successful investor and one who suffers losses often comes down to the ability to notice emerging trends before they become widely recognized. Early recognition allows for preemptive adjustments, whether it means relocating assets, increasing liquidity, or hedging against downside risks. In this sense, information functions as both a shield and a sword. It protects against potential losses while also creating opportunities for strategic advantage. Rapid response is inseparable from staying informed. Having a clear understanding of market conditions is useless if one hesitates when action is required. Druckenmiller's career demonstrates that opportunities often arise in the brief windows when markets overreact or panic sets in. Those with the agility to act decisively can capitalize on undervalued assets, reduce exposure to deteriorating positions, or reposition portfolios to withstand shocks. This requires not only preparation, but also the psychological readiness to make difficult decisions under pressure. Investors who delay or second-guess themselves in volatile periods often find that what seemed like a minor miscalculation turns into a substantial loss as markets adjust more quickly than anticipated. Technology and information tools play an essential role in maintaining this state of readiness. Real-time financial news, market analysis platforms, and economic indicators, and even AI-driven insights provide investors with the ability to track conditions continuously. Druckenmiller highlights that leveraging these tools is not about being constantly reactive to every minor fluctuation, but about creating situational awareness. Understanding when deviations represent temporary noise versus systemic shifts that require action. Informed investors differentiate between transient market volatility and structural trends, allowing them to respond with precision rather than overreacting to short-term swings. Another aspect of readiness is scenario planning. Staying informed involves not just knowing what is happening now, but anticipating what could happen next and preparing for multiple potential outcomes. Druckenmiller often emphasizes that financial crises rarely unfold exactly as expected, and the most effective investors are those who consider a range of scenarios, from moderate turbulence to extreme systemic stress. By mapping possible developments, identifying which assets are most vulnerable, and planning contingency actions, investors reduce reaction time during actual market events. This preparation creates a decisive advantage, turning uncertainty into a calculated environment where informed decisions yield better outcomes. Communication and networking further enhance readiness. Staying connected to reliable sources, financial analysts, market experts, and other informed investors provides multiple perspectives and can reveal trends or risks that may not be immediately apparent from public data alone. Druckenmiller underscores the importance of filtering information carefully, distinguishing between noise and actionable intelligence. Being part of a network of informed voices allows investors to cross-validate insights, enhancing both confidence and speed in decision-making. The ability to act quickly is amplified when decisions are supported by multiple, credible data points rather than speculation or rumor. Discipline is essential in translating information into action. Markets are emotionally charged environments, and even well-informed investors can be swayed by fear, greed, or herd behavior. Druckenmiller's philosophy emphasized that preparedness is not just about awareness, but about the commitment to act according to a well-considered strategy. Staying informed must go hand in hand with pre-defined protocols for reallocating assets, adjusting liquidity, or hedging risks. This reduces hesitation and ensures that quick action is deliberate rather than impulsive, allowing investors to exploit opportunities or mitigate losses without succumbing to panic. Finally, staying informed and ready reinforces every other aspect of wealth protection. It complements diversification, liquidity management, hard asset allocation, reduced exposure to leverage, and monitoring macroeconomic trends. Each of these strategies relies on awareness and the capacity to respond when conditions change. Druckenmiller's insight is that the speed of execution often determines success as much as the quality of the strategy itself. Markets do not wait. Crises evolve rapidly, and opportunities can vanish in moments. By committing to vigilance, continuous learning, and immediate action when required, investors create a dynamic shield around their wealth, one that is capable of adapting to uncertainty, seizing advantage, and maintaining resilience in the face of evolving financial threats.